Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, March 13th, 2016. Let's take a look at the markets. This will be an outlook, like the latest videos I've been doing on the broad markets. We'll touch on the longer term outlook, the longer term technical picture, move down to the inner or the daily charts, and then finish up with the 60-minute charts to kind of give us an idea of where we're going, not only in the next week or so here, but also the longer term. And I'll wrap up with my thoughts, or at least at some point during this video, I'll put I have some concise thoughts on both, you know, what I'm doing as a swing trader and what I'm also doing as an investor. I say that because I've had a lot of questions put to me recently, especially from those that work full-time jobs, don't trade actively, and they want to know, "Hey, Randy, I want to know when to position for the next leg down or the next big move in the market, whether it's up or down." And that I'll talk on because we're at a critical juncture right now. So I think this is a point where the next few weeks will be very telling as to where the market's going over the next few months. Whether we turn down or we break through these resistance levels that we're at and then open the door to a new upside. But this is a time I think that both longer term investors as well as swing traders should be really paying attention to what's going on here in the market. So let's dive into the charts. I'm going to talk about my trend indicators first. For those of you new to the site, this is what I refer to as my quad trend layout. I have 4 trend indicators on various time frames. This is my monthly trend indicator, meaning it's on a monthly chart. And this is my longest term trend indicator, my weekly, daily intermediate term trend you can see up here, and daily short term trends. There's multiple indicators on some of these charts. The long term, we're going to start here with the Wilshire 5000. I won't go through every index, save time in this video. The Wilshire 5000 is, in my opinion, or I believe widely known as the most comprehensive index or representative, I should say, of the entire stock market. The S&P 500 is 500 companies, and it is diversified among a lot of sectors, but it only contains mega cap stocks, the largest 500 companies in the U.S. for the most part. And then you have the Dow that's talked about on TV all the time. Well, the Dow is only 30 companies, so how indicative of the U.S. economy can 30 stocks be? So that's why we're looking at the Wilshire. And on the trend indicator, simply we have a pair here of 10-6 monthly moving out EMAs, 10 and 6 EMAs on a monthly time frame. So every candle, well, this is a line chart, I'm sorry, but every period here on this chart, all these bars, is 1 month of price action. And the Wilshire, as I've covered in recent videos, gave us, I use a scrubber here. In other words, this is the 10-6 is one of the main indicators, but I also use an ROC 12 or 13. Lately I've used the 13 on some more indices. I'll look at the 12 as well, but by setting that to a 13, it helps scrub out some false whipsaw signals like back here. We did have both confirm, at least on this index, and I don't just trade off the Wilshire alone. I'll look at the S&P, the Nasdaq, which at that time they didn't confirm. So that's why I like to look at all the major indices out there. But you can see that there are a couple signals. But this is really where we've had consecutive signals since this is the close in December, February, December, January, and February. And this is March. We're well down into solid sell signals here, into bearish territory. And I will say it's a monthly indicator, so that means only the month-end close, March 31st, matters when using these. So, but with that being said, the Wilshire would really have to giddy up and go here for the last 3 weeks of the month, or we're almost halfway through the month to turn that around. So, solidly on sell signals right now are bearish on the Wilshire 5000. Okay, I'll move through these faster. This is the Wilshire now on the weekly trend, which uses a 43 and 17 EMA pair. Done an excellent job of defining bull and bear markets. Been on a sell signal, a buy signal all the way up through, back in September, and it is solidly entrenched in a bearish or sell signal right now. Not even close to crossing over to bullish territory. So the long-term trend, by all accounts, those are my longest-term trend indicators, so weekly and monthly. They remain solidly bearish. telling me that we are most likely still well within the early stages of a new bear market that's likely to go on for at least a year. In my opinion, this one will be probably more prolonged and drawn out, not as dramatic and such a waterfall sell-off fashion as the 2008 meltdown. But we'll see. Anything's possible. This is the Wilshire on a daily time frame, the daily intermediate term trend, which I like to use as 50 and 200 day, 50 and 20 day moving average. And you can see we actually do have a little bullishness here now, bullish crossover, I should say, where that pair has just recently crossed over. Something that you need to point out here or need to keep in mind when using EMA pairs as trend indicators, the shorter the time period you move down to and the shorter the period on the MAs, the faster the signal will be. So in other words, it'll get you into a trend sooner and out of the trend earlier after the trend is changed. However, it is more prone to whipsaws. And that's the downside to using these shorter-term time frames, these shorter-term trend indicators. However, I use them in conjunction with many other factors. I never trade solely on any one thing, whether it's a breakdown of price, of support level, trend indicators, moving average crossovers. They're just all really factor into the bigger pictures, and that's what I'm doing here. Okay, again, I won't talk on the short-term trend indicators today because they're all bullish, as they should be. The market's been rallying here for the last several weeks, so as such, all the short-term trend indicators are bullish. All right, I won't go over them all. Just to rehash, that was the Wilshire, probably without a doubt, or at least in my opinion, the most representative of the overall stock market, the health of the market, and the economy, and that is clearly bearish on the monthly time frame. The weekly time frame, we have a slight crossover, bullish cross on the daily, and that is something to give us pause for. S&P 500, those have been bearish since January, and so we've had January, February confirmed. And we're here in March, still bearish so far at this point. So the long-term monthly trend is bearish. The weekly trend is solidly bearish, you can see here. And as with the Wilshire, and the S&P will trade very closely to the Wilshire. It's probably the most similar index, if you will. And that is just recently give us a bullish crossover. And we'll see if that sticks. But again, these faster indicators are more prone to whipsaw signals. But again, take it for what it's worth. So there's a little reason for pause right now on the, before getting too bearish at this point or too aggressively short. This is the NDX. Now, this is really part of my focus right now is the NDX. The NDX has been the leading index. It led this bull market on the way up, the Nasdaq 100. Let's try to center this chart here if we can. The Nasdaq 100 led us out of the gates and has been the leading index throughout this entire bull market since the March 2009 lows. And it has also led us on the way down, and my belief is that will continue to lead us on the way down. And I'm noticing some developments right now and I'll try to talk on that if there's enough time here, is really the leaders in the Nasdaq 100. I've noticed this rally over the last, especially in the last week or two here, has been led by what I call junk, a dash for trash, a lot of low quality, beat down stocks with high short interest, lousy fundamentals, and I'm not seeing the leaders. Now, take that for what it's worth. I can see out there that some might say, well, if you remember my analysis a year ago, I was pointing out and harping on the divergences, the breadth in the market, that the smaller and smaller handful of stocks, fewer and fewer stocks, large mega caps, the leaders in the S&P 500, and particularly the Nasdaq 100, were single-handedly, or for the most part, metaphorically speaking, for the most part, carrying this market up as the smaller stocks were breaking down, falling below their 200-day moving averages, making new lows, and so it's been a handful of stocks, and that's very typical with the final stages of any bull market. We saw that. I clearly remember that back in the 2007 top. Fewer and fewer stocks. Usually, it was just a handful of those big tech leaders. that kept us, led us up to new highs while the rest of the market was crumbling beneath it, and then finally the leaders crumbled. Now, where I'm going with this, in the last few weeks, I've heard people say, well, look at the breadth. We've had these breadth thrust indicators and yada, 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 a lot of broad participation. You can take that glass half empty or glass half full. I'm taking it half full, and I know that may be confirmation. I'm sorry, half empty, and that may be confirmation bias. But what I'm seeing is the rally that we've had recently was a lot of those, like I said, those garbage names, and you don't see those rallying at this point here after 6 years of market. You know, they do better in the end. They don't always blast off the bottom. A lot do. There's a lot of short covering, but lately, you know, I'm not seeing a lot of these key names lifting this market in the rally. They've been going up in sympathy. You know, a lot of the buying comes into the market. More people buying than selling. Everybody nowadays trading index ETFs. If you're shorting the Qs or you're trading the NQ E-minis, you're buying Apple and Google and Microsoft and all those because that's what the NDX is made up of. In fact, the top 10 holdings in there make up over 50% of the entire Nasdaq 100, just the top 5 stocks. So enough on that. Point being here, here's my weekly trend indicator. Solidly bearish. Let's go to the monthly and take a look at that. Now, this is interesting, and I've said this a few weeks back. The one holdout, every index I follow, the small caps, so Russell 2000, the mid caps, the Wilshire, the S&P 500, you name it, even the Nasdaq Composite, they all broke down. The Nasdaq 100 was a holdout. And again, this is a monthly indicator. I'm back on my monthly time frame, but we're for the first time, at least at this point, we're seeing both the 10-6 EMA pair and the ROC13 on sell signals are in bearish territory. They don't count until we see a March 31st close. You can look at the Nasdaq 100 backtesting that pair as they're crossing right here. So something to watch. And again, I think the next few weeks here, you know, I don't think it's time to go ahead first into the market short. If you're very aggressive, you can. I think the RR, the risk return, is pretty good right now being short. I see a minimal upside even if we continue to grind higher here in the next week or so. And this market could turn around and move down. So I'll get into that in a little bit more here in a minute when we look at the shorter term charts. I just wanted to point out that development on the developments on the Okay, and it's worth mentioning too on the intermediate term trend. I just went over the Wilshire, the S&P 500, how they've crossed now to bullish. That's also largely due to, I think, the rally in energy stocks and some other things, and the fact they're a little more diversified. We can see here the Nasdaq is still well into a sell signal here. It's coming up. This histogram is moving up, but sometimes you see these things bounce. Either way, the trend is what it is. You can take what you want from it, but right now the trend is still, the intermediate term trend is still bearish on the Nasdaq 100 and has been since all the way back to, I guess, the first of the year when it broke down right after that big breakdown from that trading range up here. So, you know, something to keep an eye on, and if it pushes higher, then there's a little more upside at potential I can see in the Nasdaq 100, but I'll get to that in the short-term charts. This is the Nasdaq Composite. Let's just talk on that. Again, the Nasdaq 100 is so over top heavy that you really want to sometimes look at don't forget about the Nasdaq Composite itself. And the Composite gave us a confirmed sell signal back in January. It did for the first time on both the 10-6 EMA pair and the ROC13. So that was our first confirmed sell signal. And again, I'm using the ROC13 to help scrub this out. They both need to trigger. Here's a ROC12 or 13 triggering back in May of 12, but we didn't even have even close to a sell signal on the 10-6 EMA pair. So that tells you just the accuracy of this. Both went green in November 30th, 2009, and you did not have a sell signal until the end of January 31st, confirmed sell signal, that is. And so that, to me, that's pretty, I don't take that too lightly. It's pretty impressive. And that's, again, the NASDAQ led us up, the NASDAQ Composite as well as the NDX. And you can see how well this indicator worked, getting you out of the bull market back all the way back here, in early 2008, telling you to get back long there. We almost had, looks like a whipsaw there, but we only had maybe one small confirming signal there. But overall, just a great job of capturing the trends. And again, bearish right here on the monthly time frame. Let's take a look at the weekly real quick. I won't zoom in. You can see it right here on the chart. You can see it's clearly bearish on the weekly time frame, and just like the Nasdaq 100, still clearly bearish, a reading of negative 18.54. So the trend on the leading index is bearish at this point in time. So be careful, on the long side. Okay, now we're looking at the Russell 2000 on a weekly chart. This is a 10-year weekly chart. This is something I've talked on for years now, the following, tracking these fib fan lines. I put these up, a couple of years back, and it's just amazed me how well the Russells played off these. For those of you not familiar, the Fibonacci fan lines, I put the bottom point here at the lows in 2009, and then you just drag the first line, and I find a trend, and that was the first major uptrend right there. And then it's just amazing how well these other lines line up. And, if you're not familiar with Fibonacci trades, read up on fibs. It's just tremendous. There's even a great special for those of you that like Nova. If you have a Roku or an Apple TV, there's a Nova on the PBS channel. Public television has a documentary called The Great Math Mystery, and it explains a lot. I think it'll make you a believer in the powers of simple things, found in mathematics, and especially Fibonacci levels and the golden ratio and things like that. So, all right, let's not get off the tangent here. There's the first level, and as I'd like to see to confirm a break of support or resistance to the upside is impulsive selling or buying. In this case, selling. We broke support, and look at that impulsive breakdown. Very impulsive. Found support on the next fib perfectly for weeks. Came back, had a brief freak out, meltdown in the market back in 2011. 1 week, kissed the next fib perfectly, shot right back above it, rode along this fib line till we broke below it, back tested from below for weeks, came down, kissed that other one nearly perfectly, came back up, rode above perfectly, the top of that fib level, came down. Just look at the reactions off this. Finally broke down there, impulsive breakdown, came back up. I moved these a hair, I had that just pretty much right there. Now I really messed them up. They're a little finicky. You got to get them just right, but you can just see how well it's done. And then most recently, and by the way, I did this in the previous bear market. Now this TC2000 charting program, as much as I love it, has its shortcomings. One of my biggest pet peeves is the fact you can only go back, 500 bars, I think, which gives you on a weekly time frame 10 years chart history. But if I could go back, which I've done before on another charting program, in the previous bull market, you had very similar action on the Russell with this, and you can see that was the last holdout, and when it broke down, it was confirmed with the impulsive selling. Actually, if you really zoom in, you can see the back test, breakdown, back test, and then the impulsive selling, and that's usually all she writes as far as the bull market goes. So that's just evidence there. I think I also had a uptrend line on my other Russell charts that this was really the bull market uptrend line. That fib level there marked what I considered the primary bull market uptrend line. This is when it broke down, and they got me here. I thought this was probably the beginning of the next bear market. We were there certainly by duration, the extent and scope of this previous bull market. But, like many indices, the Russell pushed up, made a marginal new high, and then has since rolled over. And those are the most bearish type of tops, because what happens is, things are really turning there. That's when, the natural cycle should have, Fed stepped in, whatever you want to say happened. It changed the technical outlook, and this just blows out short interest, brings bullishness to levels that you rarely see, such as I pointed out in the CPC, the put-to-call ratio recently, when we saw those triple tags of extreme ratios that have always preceded, major corrections and or bear markets. And that kind of stuff has lasting implications when you see those extreme readings, not just corrections. Those are often, especially when they come at this point, take it all into context. If it came back here, that's early in a bull market, 1, 2, 3 years in. This came after, 6+ years. This is the second or third longest. I know it was a third. We were approaching to be the second longest bull market in history. And so very long in the tooth. and also in gains as well. So there we're at. That's the Russell. Let's not spend too much more time on it. However, there's one more thing I want to show you on this chart. Talk about this a lot. I'm using a weekly chart. I like to use a PPO in lieu of the MACD. MACD is one of my favorite indicators on daily and intraday charts. PPO just does a better job, works very similar on longer term frames. And as I often talk about, it's amazing how simple yet effective the PPO and the MACD can be used as trend indicators. And what I'm circling here is when the PPO crosses below. Now, actually, what I look at is the second of the two. You have the signal line, which is a 9 EMA, and that's always going to be the last to cross. That just helps filter out whipsaws. And so this defined when the 9 EMA broke, it defined the bulk of the bear market back here. And I drew that all wrong. Sorry about that. Crossover was about this point here. Oh, wrong tool. All right, let's find the box tool here. There we go. All right, that's about when it crossed back over there, and you can see just roughly here, that's about lined up there as best I can get it. So, got you out. And since then, it stayed above. We did have this little period here where it crossed below. And you know what? That was in the Russell. That was a bear market. That was a drop of over 20%. Since then, it stayed above. I also note, well, I'll show you in a minute, on the Nasdaq, the 9 EMA has not crossed until very recently. So look at what I'm getting at now. This is bear market action here. This is just as good a trend indicator as any that I just talked on that other time frame. And I made, again, the case so many times for the longer-term bearish case that I'm probably wasting my breath here. If you're new to the site, check out the YouTube page. Go on the site, look under the market analysis on the top menu, and then you can look at some of the former videos and static posts that talk on the longer term picture. But I just wanted to confirm, because this goes into my short term thinking right now, because I can at any point in time make a bullish or bearish case on just about any time frame. So right now a lot of people are starting to get bullish because the market's been rallying and taking out some of the resistance levels where some people thought it would turn down at. And that can continue for a little while, but don't lose sight of the bigger picture. And if this is a bear market rally, which by all the long-term metrics I use it is, things are going to turn on a dime, and it's going to catch most off guard when they least expect it. So just be careful, and I'm just pointing out the evidence here. Now let's look at the NDX, Nasdaq 100. Okay, this is what I was just talking about here. The Nasdaq has been the leader, and this was, as I mentioned, here's the PPO back then, caught the bulk of the bear market back in '08, and as you can see here, that white line, that 9 EMA, has not crossed below for the entire bull market until recently. We'll have to zoom in here so you guys can see it, and we're clearly below right now. I don't see any bullish divergence on the weekly chart. If I'm in a bear market, that's what I look for a bear market to end. One of the things is bullish divergence on the weekly time frame, and I'm not seeing that at all. We had bullish divergence on the daily time frame recently, and that's why I was long and bullish a few weeks back. But right now, this is early stage bear market action to me, and there's that 40-week EMA, same as a 200-day moving average, done a great job pretty good job, I should say, of defining bull and bear trends, and we're right now testing that. So like I said, I think this is an objective time to be short, be adding on whether you're a swing trader or a longer-term trader, and I'll go over some more specific levels as we zoom down on the charts here. Okay, here's the S&P 500. This is a couple key levels on the chart. Really the horizontal, look at the horizontal lines that I have here. Now I said a few weeks back as we were approaching, all eyes, everybody was talking about 1990 and 2000, even I was. But one thing I did say is that from my experience, when too many eyes, when everyone's watching the same level, the market does one of two things. It either falls shy of that level or it goes right on through it. It'd be just too easy. Too many people are waiting to back the truck up short here, and I also stated a few weeks ago in one of my videos that my expectation is we'd probably punch on through it, which is what we've done. So now I have these levels here. Now, I'm only right if that turns back down. I still expect to turn down because I've reduced all throughout here in the last couple of weeks. I've unwound a lot of long exposure, the bulk of my long exposure, not all of it, but select positions I still like, especially some of the growth and income trades. A lot of those have already exceeded their targets, so I'm out, but there's still some I hold. However, I've scaled in short, and I have a pretty decent short exposure now, but at this point, I don't have any interest in adding. I don't think the market has any business being much above, well, really this level here. This is my line in the sand. At 2040, any daily close above there is where I will start to scale out. And if we continue to climb, I think the odds are good that we're going to go and try to challenge these highs. There's still a mountain of overhead resistance. So let me put it to you this way. I don't think the risk, I think the risk reward to being short favors the short side right here because I don't see the market running up. We just shot up. I'm just using my line draw tool here. That's 11% in just a few weeks there. I don't see us going up another 10, 11% without any type of correction, consolidation, or pullback. This, again, is a mountain, a wall of resistance overhead. Here's that big trading zone, the S&P 500. It's not as well defined as the Nasdaq, but we have this whole level here. That's supply, we call it. That's like a big rounding top on the S&P 500. Can we get through it? Anything's possible. But again, I feel good being short here. If I get taken out, that's just part of the game. And I don't plan to add. I really don't want to see us much above this 2020 level. I know we closed at 2022. So this week, I won't be adding unless I see us start to move back down. I left dry powder. And I'm not going to continue to scale it up here. I'll hold off if we happen to take out 2040. But let me also get over to the small caps and QQQ, and then I'll talk on that because I don't have any positions in the SPY. I don't care to. In fact, I've been most bullish on things that the SPY owns, like energy and basic materials, things like that. That's where I've been trading. Doing a lot of my long side trades lately. And I still see some bullish charts there. So I just wanted to point that out because I know a lot of people watch the S&P 500, and it is important. So those are the levels. Let's see us stay between, definitely between 2040, especially in daily closes. Intraday, it's almost a given that any key level now, we're probably going to spike through it intraday. That's what the markets do. If there's a key level and everyone's watching it, they're going to run it through there, run the stops, and then reverse. So I'm more partial to, when swing trading or longer-term positioning, like I am right now for what may be a longer leg down, daily closes. I'm not too interested in what the market and all this intraday noise. It just doesn't even get to me anymore. Okay, let's look at the Qs here. This is a Qs daily chart, QQQ. This is a very nice resistance level here, this orange line. Now, this chart might be busy, and I apologize. I know there's a lot of color, a lot of different trend line colors I put and other things. But just look at this line right here. Look at the reactions back here, here, here. Reactions from below, reactions from above, reactions here. There was, a little spike there, but you can see numerous reactions back here. Broke above it. Consolidated. There's that range I kept talking about. This was the golden short entry. This was the consolidation range from late 2015. It broke down right on the first trading day of the year, I believe it was, and that was a great short entry. It gave us a back test to get in. That was a great short right there. And this was a great long. I pointed out things like the positive divergence. We had the negative divergence at the top, and we had positive divergence at the low. So you can see it there. Those are the charts. Pretty simple. And I'll get down to the 60 minutes here. 60-minute charts in a second. So right now we're through that level a little bit, but not a whole lot. Again, these brief day or two spikes, no big deal. There's the 200-day moving average, that red line. The Nasdaq has a little more to push up than the S&P, but again, I don't have an interest of adding, even though we're back testing some of those 60-minute wedges. I'm going to watch, and if we get above here, I'm more concerned about starting to protect my positions. And if we're above this green line, that's my line in the sand for my shorts and the Qs. I'm only, as far as broad markets, I only have the Russell 2000 and the Nasdaq 100 are my only shorts. And as I mentioned, my preference, and I just haven't had the time to really dig into the charts. I have a few individual shorts, but I really want to position for the next leg down. If I get my market calls right, if I can call a 10, 15, even a 5, 8% move in the market, 99 times out of 100, I will pick individual stocks with more bullish or bearish patterns that will outperform what the broad markets do, fivefold easily. The broad markets, you trade the SPY, you're trading energy with basic materials, with banks, financials, retail, utilities, things that go up when other things go down. It's almost a counterproductive thing. And I don't know, people love the broad markets, and I do it out of laziness sometimes, for lack of a better word. Having been busy with the site and posting a lot of activity in the trading room, I haven't had time to really sit down and pour through the charts and have a lot of short candidates. So I did take some, IWM and QQQ I scaled into in the last couple of weeks. But again, my preference, especially if I start to see evidence that we're rolling back down and may take out these lows and have another sharp leg down, I'll have plenty of short trade ideas on by that time. And if I don't, I can always add to it. It's, QQQ, IWM, the leverage ETFs, they're easy to add and subtract, close out and move into something else. So those are the levels I'm watching, guys. That's on the Qs, that's about 108, just over 108, that line there. And this line in the sand is about 109.85, maybe a little above that. You can see that gap just above it. So call it 109. So, 110. I'm sorry, 110.30. There's a gap, big gap right there. So that's the level I don't want to see us get above. Okay, let's wrap this up with the 60-minute charts here. Those are really what I'm putting a lot of focus in right now. I watch the daily and weekly charts, but they don't change on a day-to-day basis. Keep an eye on them. But this is what I'm watching. Here's that rising wedge pattern. We have rising wedge patterns, as I pointed out, in all the major indices. This is the Qs. We broke down. We've moved back up. See this blue line here? It's at 106.25. If you recall, back here, I was short up here. Already had a TQ short officially on the site, quite a few individual stocks. Shorted that breakdown, pointed out we broke down. That was a big move, very lucrative. That started out, as a great year, shorting that down and covering right here at the lows. And at the time, I put up these targets and went long. Gosh, I can't remember now. I know Apple was one of them. I think we might have had a long in the Qs. And that was the first target where I closed that out in all my longs at that point in time. But I did have that additional target, even though I closed everything out earlier. And we moved back down. That was some great day trading action in here. And then back here, I went long again for the reasons cited on the site at the time. Started scaling long here, got along a little early, but stayed long and have done really nice on this leg up. Especially with day trades as well as swing trades. Now that wedge broke down. So there it is. It's very clear here. The reason I was bullish at the time, and this is all pointed out again, this isn't hindsight stuff, this was all pointed out in advance before we even hit this low, bullish divergence on the 60-minute charts. When I'm trading a trend, a primary trend, the primary trend right now, it's still early stage, not 100% that we're in a new bear market, but if assuming the primary trend is down, which my indicators tell me it is, the long-term indicators, these are counter trend trades, these longs, and typically I like to see divergence on the 60-minute time frame or greater. 60-minute daily, if you can get it, great. The longer the time frame the divergence is on, the longer the trade will play out for. In the shorter terms, if you're looking at 5, 15-minute charts, 30-minute charts, and you're looking at bullish setups, bullish divergence, those are more likely to fail the same way that bearish divergence on the short-term time frame will fail more often, or bearish chart patterns in a bull trend. So that's what I'm looking at now. So we had another divergent low here that kept me bullish, kept me long. We did good there. Now look at this divergence. I pointed out divergence here, and that hasn't played out. It's played out for a little bit. What happened? Prices pushed back up. Does this mean I'm wrong? Absolutely not. If it keeps going, I am. But right now, I'm looking at these indicators, and now you can see the MACD, it hasn't curled down yet. So it's not what I'd call confirmed divergence at this point, but so far this is a lower high. We have a high, another high, a lower high, that's negative divergence, and now a third possibly lower high, especially if we turn down, because prices have made now a marginal new high. They just eked out, closed above this high over here. So this is just an extension, and the longer the divergence gets, the more powerful that reversal is. So in that divergence, you can see here on the RSI and this trend indicator. So video is getting long. I'm going to go over and just wrap up because you may be trading the Qs. IWM, it's an official trade, at least a TNA short. I like to short that in case we get stuck in a sideways trading range. Let that leverage work for us. Here's that rising wedge in IWM, I should say. We broke down, and we're still below the highs. So IWM is looking real good from a short perspective. You know, where the SPY and Qs just went on, made a marginal new high over this previous high. Small caps are lagging at this point, so that's a solid breakdown. Yeah, that trend indicator moved back slightly. It's just whipping around here. It gave us a sell signal here, and then it went back bullish. You can see there, but we had that divergent high, and this is just a nice wall of resistance up here. These two levels, and that should show back here if we go a little longer. No, I don't have it on this same chart, but either way, those are the levels I'll be concerned about. And I already listed my stops on the Russell. It's on the short trade. It's based on the daily chart or the daily close on the Russell. All right, we'll wrap it up. Look at the SPY, there's the SPY. Nice rising wedge, breakdown and a back test. Somebody pointed out in the trading room the other day, here's that gap. You can see the top of this gap over here. If we gap up tomorrow on Monday, tomorrow morning, that'll take us to a nice back test of that wedge and a backfill of that gap. Gaps are like magnets. Here's the thing. We entered that gap on Friday, but we closed just above inside it. And gaps very often once entered are backfilled. So maybe we pop up in the open, and just like the Qs, look at if we turn down, and you can see the MACD is starting to curl down. This divergence extends. So we have negative divergence, bearish rising wedge, breakdown back test at major resistance. If you go back to those daily charts I was just looking at, or resistance area, it's not super well defined, but there's definitely a lot of overhead resistance with the long-term trend indicators being bearish. And that's it, guys. I may be wrong on this one, but it's you have a preponderance of evidence. It all stacks up. It's like defendant being tried in court. If there's enough evidence to prove he's guilty, then he's guilty. If there's enough evidence to prove this is a bear market rally, then it's probably a bear market rally. And that's the case I'm making now. So I showed you the levels where I'll be concerned, or if I'm wrong and this turns into anything more. But right now, I think it's at the very least, if you're long, tighten your stops. You can set stops, ratchet those up. If you're short, don't let it get away from you if you continue higher. And if these bearish patterns just burn out, in other words, if they're negated, if the MACD on the Russell, the small caps, large caps, SPY, QQQ, if the MACD takes out, makes a higher high, keeps moving up, prices move a lot higher. These wedges should backtest here, but don't have, again, the prices just don't have really any business getting up much higher than where they're at now. So I think this next week will be pretty critical. And if you haven't done anything yet and you want to take the cautious route, sit on your hands, wait for a reversal to come, and you'll probably know if it comes, it'll probably be pretty quickly. I don't think we're going to move sideways. I think if the bulls can't just bust these patterns up in the next few days here by midweek or so, we'll probably start coming down pretty hard, and at least coming down. I mean, gosh, we haven't back tested the top of this range here. We did one time, but the SPY can come down to 194 in a blink, and it's at almost 203 right now. So, all right, guys, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.